We all know the crypto markets can be, well, pretty wild. But every once in a while, a token's price action is so completely off the charts that it just becomes a spectacle. Today, we're going to break down one of those moments, the absolutely insane, chaotic ride of the Aria token. Just look at this number. 1,260.2%. That's the kind of volatility the Aria token saw in just 24 hours. No, that is not a typo. It's the kind of move that can make fortunes and, just as easily, wipe them out in the time it takes to go get lunch. So the big question is, right, how does an asset's price just do that? I mean, what causes a swing this massive? Is it some kind of coordinated market manipulation? A massive news story that dropped? Or is it just pure, unfiltered speculative madness? Well, we've dug into all of it. The data, the social media chatter, the project itself, to piece together what really happened. Okay, so the day was April 9th, 2026. And for anyone trading the Aria token, it must have felt like an eternity, all crammed into a single day of just one heart-stopping price alert after another. And wow, this timeline really lays out the madness. Okay, so you start here at the 24-hour low. The token's just sitting there at a little over 6 cents. Then the surge begins, an absolutely vertical climb to a high of 83 cents. But just as fast as it went up, it came crashing down. A 90% flash crash, basically in minutes. I mean, from the peak to the bottom, it was a truly brutal ride. To really get what happened, let's start with our first clue. And it comes from the digital trenches, the social media platforms and trading forums, where this intense, emotional battle was playing out in real time. So on one side, you've got the bulls, right? The true believers, absolutely convinced this was their moment. You saw posts just like this one everywhere. They saw a short squeeze happening, thinking that buyers were totally in control and the price had nowhere to go but up. But, and this is key, at the exact same time, you had the bears saying the complete opposite. They saw a house of cards ready to tumble. They're talking about relentless selling pressure, and they were convinced that anyone betting on the price to go up, the longs, was about to get absolutely wrecked. And this wasn't just a one-off comment here and there. It was a constant back and forth. One minute, the bulls are celebrating a heavy squeeze that just liquidated all the short sellers. The next minute, the bears are pointing to a wall of selling. All this raw emotion, out in the open, just supercharged the entire trading environment. So what you have here is basically two armies locked in a brutal tug-of-war. The bulls are screaming short squeeze and buyers are in control, while the bears are shouting about relentless selling pressure and a weak structure. This conflict wasn't just reflecting the volatility, it was pouring gasoline on the fire. Okay, so that's the human emotion part, but that alone doesn't explain the speed of the moves. For that, we gotta look at clue number 2, and it takes us deep into the mechanics of trading. We need to talk about liquidations. So what in the world is a liquidation? Let's break it down real simple. If you bet the price is gonna go up using borrowed money, that's called a long. And instead it goes down, the exchange basically force closes your trade to cover your losses. It happens automatically. Same thing if you bet the price will go down, a short, and it shoots up instead. It's a force exit, it happens in a flash. And you've got to understand, traders are watching for these things live. Here's a post calling out a long liquidation. See, when a long position gets force closed, the exchange has to sell those assets on the open market. That creates even more selling pressure, which pushes the price down even lower, even faster. Now, flip that coin over and you get this, a short liquidation. This is the engine that drives a short squeeze. When people who bet against Aria get liquidated, the exchange is forced to buy tokens to close their positions, and that creates a sudden tidal wave of buying that sends the price skyrocketing. And this is the really crazy part. It creates this massive domino effect. One big liquidation pushes the price just enough to trigger the next person's liquidation, which then triggers the next and the next. It's a chain reaction, and it's what turns a small price move into an absolutely colossal pump or dump. So if these liquidations are like dominoes, you have to ask, who pushed the first one? And that brings us to clue number 3, the people often pulling the strings behind the scenes. We're talking about whales. So a crypto whale, it's just what it sounds like, a really, really big fish in a small pond. They're an account that holds a massive amount of a token. And because the market for a smaller coin like Aria isn't that deep, a single whale deciding to buy or sell can move the price way more than thousands of small traders combined. And this isn't just speculation. We can actually see it in the data from the blockchain. Analysts saw that right before that huge surge, whales started pulling massive amounts of Aria off of exchanges. This basically reduced the supply available to buy, creating what's called a liquidity squeeze. It made it way easier to pump the price up. And when you see that large holders own over half the entire supply, you start to see just how much power they have. Okay, so we've got the emotional crowd, the crazy market mechanics, and the big money whales. But that brings us to our last and maybe most important clue. What were they all trading? What is Aria anyway? Well, if you go by the official description, it sounds pretty incredible, right? It's talking about gaming, AI, Web3, inspired by Disney. I mean, this is the kind of big, ambitious vision that gets people excited and attracts a ton of speculative money. But when you pull back the curtain and put that shiny pitch next to the gritty reality, well, you get a very different picture. On one hand, you have this exciting vision of GameFi and AI, but on the other, you have some really serious risks. The token already had a history of these massive flash crashes, and a security audit called the project's smart contract a black box with unpublished code, which is a huge red flag for investors. All right, let's put all these pieces together. What we're looking at here isn't one single thing. It's a bunch of different factors all colliding at once to create the perfect storm for this kind of insane volatility. So here's the anatomy of it. Number one, you have a super passionate, emotional crowd of traders completely divided and fueling the fire. Number two, you have these market mechanics, liquidations that act like a turbocharger for every price move. Three, you have clear evidence of whale activity helping to orchestrate the pump. And number four, all of this is happening with a highly speculative project that has a great pitch, but some serious fundamental risks under the hood. Look, the big takeaway here isn't just about Aria. This whole saga is a perfect case study of how these speculative crypto markets work. It's a powerful lesson in how human emotion, complex financial tools, and fundamental project risk can all mix together into one seriously explosive cocktail. And that really leaves us with a huge question, doesn't it? When you see a story like this play out, what does it tell you about the market itself? Is this a sneak peek at some radical new future of finance? Or does it look a whole lot more like a 24/7 global digital casino? The truth is probably somewhere in the middle.